The sensex and the Nifty are down 2% this week, the biggest 5-day decline in nearly a month. The cuts are much sharper for the midcap space. The Midcap Index has lost 6% this week. All sectoral indices, barring the IT index, ended the week down in negative territory. So what is the road ahead looking like for this market? It's been a rocky start to the year. You're watching Editors Roundtable. I'm Surabhi Upadhyay, and with me as always, Prashant, Nigel and Nimesh. And in a bit, we'll also be joined by Harish Bihani, Senior Fund Manager at Kotak Mutual Fund. Guys, I think the bulls are going to say, thank God, it's Friday.
And you said it's a rocking start of the year. Yeah, it looks like it's rocking. It's rocked everybody.
Rocking for sure.
Every investor is now rocking.
Rocking for sure.
Oh God, I mean the kind of damage is done in the broader market stocks in the portfolio.
Rocky. Isko why karte hain?
I think that barring that one session, I think on January 2nd, barring that, actually it's been all down. You know, so, every single day you've seen a lot of selling, a lot of pressure, and we're talking about the index correcting 2%, 3%. Well, portfolios are around 20%.
So it's not about, this week the portfolios are 20%. The actual fall started from December 16th. If you look at December 16th to now, a lot of the individual portfolios are down 20-30%, and individual stocks are down more than 30%. So it's been that kind of a brutal sell-off in the broader market. And we had a great run, right? For the last couple of years, mid and small cap have outperformed every year. And we keep saying that the large caps will do a catch-up rally. It didn't happen for the last 3 years. So it looks like maybe 25 is a year when, large caps they don't fall much, and mid caps fall much more. So,
therefore, large caps look like they're outperforming.
That mean divergence should happen, I guess, between the broader markets and large caps.
Nimesh, IIFL, I think, put out the data. This is 5 days old. Said that 2020 onwards, from 2020 till now, that is December 31st, 2024, we're in 25. Nifty stocks has seen a CAGR of Nifty has seen a CAGR of 25%. On the other hand, the small cap index has seen a CAGR of 30%. There has been no period for even in the US. US, for example, the best period for stocks was, I think, between 94 and 98. In 5 years, the US market went up 3 times. And then, of course, there was a dot-com, the entire thing which happened. Even that, of course, pales in comparison to what we've seen. So actually, when you look at the fall, etc., it obviously is painful. But the context is important that we've had such a fantastic run, unprecedented.
And again, this whole rally in the mid and small cap is backed by fundamentals as well. The numbers have actually improved for a lot of sectors and a lot of companies. So it was backed by good amount of earnings as well. Now there are first signs of crack happening in the earnings as well. Q2 was the first set. If that continues, then maybe you'll see a bit of rub-off in the broader market. So you might have a underperforming year.
And everyone thought 2025, from the second half of January, we'll see a lot of action. Trump will come in, we'll have the...
Now the commentary start the second half of this year, 25, forget second half of January.
The first half of January itself, we have so much of action. Trump is coming on 20th. You have the Fed meeting next.
By the way, it is not 20th, it is 1 week.
Today is a 10.
That's what I'm saying. But I'm saying the first 10 days, you have so much of action with regard to markets, with regard to 90 hours working.
Maybe he'll be the lucky.
A lot of other things.
Maybe he'll be the lucky charm. After 20th of Jan, maybe the bulls have a rally. But anyway, let's quickly recap what has been a really painful week for the market. So like the headline told you, the Nifty is down 2%, but that's not the story at all. The story is the absolute pain that's played out in the broader market. The Midcap Index, at the index level, it's down about 6%. The small cap index has lost over 7%. And the extent of the slide has been so broad that it's taken all sectors down with it. PSU stocks have been pummeled this week. They're absolutely out of favor. Not just PSU banks, but even, the other, yesteryear stars from the railways arena, etc., stocks like NBCC, a lot of them down and out. We're talking about a decline of almost 8 to 9% on the various PSU indices that are there. But even beyond that, nothing has worked in the market. There's been no counterweight. Friday, to an extent, thanks to TCS, there was green on the IT screen, and because of that, the IT index has managed some green for the week. But otherwise, even FMCG is not worked. We had a flash in the pan day on Thursday. There was some buying in FMCG, but it did not last. None of the other heavyweights in the market are holding up. Reliance did not work, and banks have their own cross to bear. The bank Nifty has been down almost 5% this week. And if you look at brokerage notes, a lot of these notes are now questioning whether the margin profile will remain intact or not, whether credit costs are going to go up. So the narrative is getting very tricky on the fundamentals for bank stocks as well. So all things put together, it's become a bit of a perfect storm.
Absolutely. One more thing I was thinking as we were
discussing.
And
the flows. Sorry, I didn't mention the flows. Just to add to this,
status quo. You can just say status quo.
Status quo, and the numbers just get bigger and bigger.
They continue to sell.
The Thursday number was over 7,000 crores of selling. The only silver lining, should add this, that so far domestic money has kept the faith.
Yeah.
Imagine this market if you didn't get 41,000 crores of inflows into equity mutual funds. Imagine where this market would have been. But that's the silver lining that we're holding on to.
Well, let's go across to Harish Bihani, who's with us, Senior Fund Manager at Kotak Mutual Fund. Harish, good to have you with us here on the program. So when we started this year, the general, for the last 2 months, actually last 2 months of 2024, the general view has been, at least from the institutional fund managers, that time to move into large caps because broader markets, mid and small caps, etc., are too expensive. That for at least 2 months did not work out. I'm not sure whether it's working out now, because now what's happening is this week, for example, the small cap index has lost 7%, as Surabhi pointed out. And of course, mid caps, the larger caps continue to fall. There's no recovery. So everything is now uniformly down. Actually, from the all-time high, Nifty, Bank Nifty, mid cap, small cap, everything is down 10%. So what does one do? Harish, your thoughts?
Sure, Prashant. So, Prashant, let's look at the context of why market is correcting. We're clearly seeing an economic slowdown. In that context of slowdown, what market is telling you is that there are many issues, including fiscal impulse, which is fairly weak as we speak. In that context, any company, whether it's a large cap company, mid cap company, small cap company, that is growing in double digits with improvement in cash flow is doing well. And that will highly likely continue for fiscal 26.
Okay, all right. No, I mean, that's nicely put, Harish. Let's kick it off, right, with the individual pieces here. Earnings season is kicked off, and TCS, of course, has reported the third quarter numbers, largely in line with expectations, but the commentary is sounding a little better. What is the market in the street making of it? Nigel, you put this together.
Well, when in doubt, turn to TCS. And that's been the one that batted for the bulls, particularly on Friday's trading session. And Rima puts it perfectly, right, the way she summarizes this. I'm just taking some of those points that she had put up. First of all, TCS did well because getting into the numbers, the stock ended at the low point of the day. So that was additional reason, that technical factor that plays out, the shorts got squeezed out. And that's why, in fact, we did see a big bounce up on the stock. Now, why did the bulls like these numbers? First, if you look at it in the last 1 year, pull up all the top IT companies, it's a relative underperformer. So it's making up some of that underperformance. Point number one. Point number two is, traditionally, TCS always trades at a premium in comparison to Infosys. But because of this recent underperformance, now Infosys as well as TCS, they were trading at similar valuations. So that's why, the market wants to give it that benefit of that valuation premium. And that's why, in fact, we did see a bit of a catch up as well. Next, the revenue, yes, that was a bit of a miss. However, it was largely in line with expectations and no big disappointment out there. And the biggest positive for the numbers was, in fact, the deal wins. If you look at it on a quarter-to-quarter basis, the deal wins were up by close to 19%. On a year-on-year basis, it was up close to 26%. And that was the biggest positive in these numbers, along with the commentary. So let's tell you something, some part of what the management said. They said the discretionary spends, gradual signs are there of it coming back. The coming fiscal will be much better than the last fiscal. And they said sentiment as well is improving. So put that together, the markets like that. Brokerages, CLSA is arguing that point. Valuation-wise, well, there is some support out there. And in FY26, we're going to see an EPS growth of close to around 14%, which compares with around 9 to around 10% that we have seen. While we have HSBC, they're saying that, yes, the things could be bottoming out, but they're still a little bit cautious on the stock. TCS was the stock of Friday, and thank God for it. Otherwise, we would have ended much lower, and it pulled up the entire tech pack as well.
Absolutely, and I think it's by the way, the IT index, Nigel, from the all-time highs is just about 3% away.
Yeah.
So IT and pharma, right, the so-called defensives are defending.
Yeah, indeed.
Defending nicely.
And with the kind of updates and all you're getting, a fund manager has to allocate some money. So this will be the space where they're saying at least you'll get some kind of growth, some kind of positive
sector is under-owned. If you look at the ownership pattern, IT and pharma are still under-owned by a lot of funds. So even that's going to have an impact on the performance.
Let's hear it from Harish. Harish, what do you make of the numbers that we've gotten from TCS for the tech space? It's a little bit under-owned, as Nimesh is telling us. How do you approach the sector?
Nigel, there's a tug of war going on between the positives and negatives when you look at the IT sector. First of all, you look at the positives. At the margin, things are improving. Discretionary spend is improving. So that's a clear positive. Second positive is rupee depreciation, which was clearly not the case for the last 2 years. So at the margin, rupee is depreciating. And the forecast is that rupee could depreciate even further. So that is a positive. On the other hand, if you look at the issues which could crop up in the sector, one is the Trump policies. There's this big known unknown as far as the Trump policies goes. So we'll have to navigate this very carefully, especially in the context of where valuations are for the IT sector. IT sector valuations, especially in the mid-cap space, are at an all-time high. Even the large caps is significantly ahead of pre-COVID numbers. So companies which will be reporting better visibility in terms of the earnings and cash flow for fiscal 26, they will be clear winners, and market is clearly gravitating towards those as we speak.
Okay, that's of course on the IT side of it. But the other debate in the market is the move towards large caps. And if I broaden that, I know, Nimesh, you've been looking at some data, and a lot of sort of market experts are talking about it. Whether stocks that have not worked so far, you know, the so-called fallen angels or, you know, the bummed out stocks, whether they can be a good place to be in this year.
So again, you know, I'll show that with the data, with the historical data. So as you rightly pointed out, you know, a lot of experts have been saying that maybe 25 is a challenging year and focus on large caps. So the question is, you know, is this time to buy the fallen angels? So let me go to the wall and explain why I'm saying this. You know, I just looked at a lot of historical data as well. The key question is this a time to buy the fallen angels? What I mean is the underperformers of previous years generally turns out to be outperformers the very next year. So that's the theme. If you look at 2024, which are the sectors which underperformed? Financial was a big underperformer, staples were big underperformers, and within the large cap, Reliance was one big name which actually underperformed in 2024. So that's the kind of performance in 24. But if you look at the history, every year the underperformers of previous years turns out to be outperformers the very next year. Look at the 2020 table. If you look at 2020, the big underperformers were some of the PSU names: Coal India, ONGC, SBI, NTPC, all were down between 15-18%. To 35%. This list also includes the likes of SBI Life and Bajaj Finserv. Similar stocks in if you look at same stocks in 2021, all have actually outperformed the very next year. So that was the table for 2020. Now look at 2021. In 2021, some of the auto stocks underperformed. Bajaj Auto, Maruti, Hero MotoCorp, and the likes of HUL and IndusInd Bank. They all underperformed in 21. Look at the performance in 22. They all were the gainers between 10% all the way to 40%. So that's the list of 2021. Similar is the case in 2022 as well. Look at the big underperformers of 2022. Lot of IT names: Wipro, HCL Tech Mahindra, all down 20-40%. Tata Motors was down 20%. DRL and Apollo Hospitals were down 11-12%. And what they did in 2022? All were up between 20 to 100%. Look at something like Tata Motors. It was down 20% in 22. It rallied 100% in 23. So that's the kind of outperformance we see the very next year. However, having said that, there are some exceptions as well. You know, it's like 90% of the time you see the trend going up. That was not the case in 23 in one particular instance. There was one stock in 2023 it underperformed, and it happened in 24 and repeat in 24 as well. That is Adani Enterprise. That stock ended 26% lower in 23, and it underperformed another 11% in 24. So, as I said, you know, there are some exceptions as well in this particular trend. Now, look at what's the trend in 24. If you look at the big underperformers of 24, here's the list. IndusInd Bank is down 40%, Asian Paints 13%, Asian Paints is down 33%, Nestle, Tata Consumer, HUL, all of those consumer names are down. Adani Enterprise, which was part of it, down 11%. And so are some of the large cap names like Reliance, Tata Motors. They all have been big underperformers of 24. This is the potential upside that the analysts have put out in their, the analysts which track these companies, right? IndusInd Bank, the potential upside according to the analysts is close to 40%. Asian Paints, 8%. Nestle is 10%. For Tata Consumer, it's 22% potential upside. For the likes of Adani Enterprise, for the 2 consecutive years, it actually ended lower. The potential upside, according to the analyst, is 72%. Only 4 or 5 analysts track it, but that's the trend. Britannia, Bajaj Finserv. Look at the Bajaj twins. They both ended 7% lower last year, but this year the potential upside could be 8-10%. Same is with Kotak Bank, a big underperform within the private banks. The potential upside is 12%. The big stock to watch would be Reliance. It underperformed last year, down 6%. But if you look at the street estimates, they're anyway hoping for 25 to 26% return in this year, and so is the case with Tata Motors. So the big question is, can the data at least suggest that the previous year's underperformance turns out to be outperformers in the next year. So let me ask Harish if he's heard the data. Harish, what's your call on the large caps? You know, generally the focus is that this could be the year for large caps. You heard the data. The financials have underperformed, Reliance has underperformed, and so has some of those consumption names as well. Anything that fits into your investment profile at this point in time?
Sure, Nimish. So when we look at some of these fallen angels, we try and think through on what is the variant perception that I have, which will lead to a different opinion versus what market is thinking of right now, and the outcome could get better over time. If, say, for example, in case of banking names, it could be simply because liquidity is improving, regulatory tightening, regulatory things is easing as we speak. When you look at the say a paints name, the entire paint sector, it could be simply because capital cycle is improving. So we'll have to think about the variant perception. If you look at the consumption names, for example, the staples, do we see an improvement both in terms of urban consumption as well as rural consumption? And will it be a minor improvement or will it be a significant improvement? So variant perception will ensure that some of these fallen angels will make significant money over the next couple of years. If we do not have any difference versus what market is thinking of today, we do not make money in such stocks.
Sure. Harish, the other part was the financials. If you look at, like, say, IndusInd Bank or the NBFCs like Bajaj Finance, Bajaj Finserv, broadly in the financials, where do you stand? Because MFIs have seen a bit of a pullback as well. Fundamentally, where do you stand on the financials, and do you think it's all in the price at this point that, most of the negative seems to be in the price?
When you look at from a price perspective, they look fairly reasonable. The challenges are many. First is in terms of the overall liquidity. Liquidity has tightened further in January. Liquidity went to a surplus in December. It's again back to a deficit in January. So liquidity is certainly an issue, which has clearly an impact on the NIMs of all the banking names. You look at the overall regulatory tightening that happened last year across large cap, mid cap, small cap, whether you look at MFI sector, you look at many other sectors in the NBFC space. So those needs to ease for us to be able to have a view that we can make money in some of these financial names from here on.
All right, got it. Do stay on. We have to take a very quick break, but the conversation continues on the other side.